Well, let's look at something that we've not looked at. A company called Vail, Vail Resorts. They're in the resort and casinos industry. I love their symbol here, MTN for mountain. I think they're mostly known for Vail. I think they're expanded over the time, but for skiing is what they're kind of known for. Another company with a high short on the float, 16.4%. That's not good. They do have a PE of 22.1. The industry, nothing there at all. Price of sales, 1.9 versus 1.4. Price of book value, very expensive, 35.2 versus 2.8. I'd imagine they have a lot of real estate in their portfolio, but I could be wrong on that. Price of cash flow, 9.6 versus 7.6. PEG ratio, 2.5. Yeah, that's okay. The industry's up 4.8. We do see earnings are up 14.7%, which is not bad, but not as good as the industry, up 27.5. And sales for Vail Resorts was up 3.1% of last year, just below the industry of 4.9. They get a 5-year growth rate on their earnings from the analysts of only 3%. The industry's up 8.4, so that's not good for Vail Resorts. Dividend, nice dividend here, 5.8%, but they use 127% of their earnings to pay that out, and the free cash flow amount for the payout ratio, 93%. That's pretty high. Kind of warning you could see a cut in that dividend down the road here if things don't improve quickly for them. I think they probably need a lot of snow this year is what they probably need to get up their sales. Look at the balance sheet. Not a good thing here. Current ratio 0.5 versus 1.3. That's a little bit low. That worries me on the liquidity side. Debt to equity 21.9 versus 6.2. Those two things combined kind of says maybe there's something else going on with Vail Resorts that, we talk about the franchises, different things here. So that's just such a strange number. You got to understand that before you invest in this company. Net profit margin 9% versus 5.5. Return on equity, wow, 170.3%. I'm telling you, that probably means a very low equity. And then free cash flow is 352 versus $780 million there. I'm hoping you got something better going forward because so far the only thing I like is a dividend, which could be cut.
Well, the interesting thing is I'm surprised this company is not a REIT. It looks like it's just a normal company. I mean, we're not looking at FFO.
Did you see if there was a lot of real estate in it?
It operates in 3 segments: mountain, lodging, and real estate.
Oh.
So, I don't think I'd step in and buy something like this because it wouldn't necessarily fit our rules.
Right.
But you could almost justify that maybe those earnings are lower than they should be if there's a lot of depreciation. Maybe their cash flow is much stronger than they should be. Because when I look at this, I mean, you're right, it's not in Vail, Colorado anymore. I was blown away by this. I mean, they're in Europe, they're in Australia, they're in Canada. They have, resorts all across the country in, the United States as well. I mean, you're in California, you're in Utah, you're in, it looks like even back east, you're in many different places. I was kind of surprised. I thought they would be really concentrated in Colorado, but they have resorts all across the country and the world.
Yeah. Wow.
But looking at the numbers, it's $153.53 is the current price for Vail at their ticker symbol MTN for Mountain. 52-week range, though. The low, $129.85. The high, $191.85. Year-to-date, the stock is down almost 20%. But this is kind of what I'm talking about. The earnings still don't look that great. You out to July 2027, estimated earnings per share here, $7.94. Gives you a target sell price of just $131.80. But, I mean, if they have a ton of depreciation, that's really going to, exacerbate the earnings versus the cash flow. And, we generally buy our companies based off earnings, not cash flow, unless they're a REIT. But I'm surprised they don't function as a REIT.
And I did look at the equity because why it's so low. It's $156 million now. Just 3 years ago, it's $1.3 billion. The liabilities are up about $600 million there. So I agree with this. Kind of misplaced. It's hard to value this company.
Unless what they did was they sold off a lot of their real estate and now are focusing more on the operation. So like if you're a casino company, right, like MGM, well, they sold off their real estate. Now they're focusing on the operations. Maybe Vail did something similar, and maybe that's why they're a company, not a REIT. But been kind of surprising, as I'm sure a lot of that real estate would be quite valuable.
Yeah, interesting thing there to kind of look at. And that's why we spend time looking at. We tell people before you buy anything, it's 10, 15, 20 hours of research because there's so much to kind of look at. We just try to point in the right direction here.
And I think, unfortunately, with Vail, I think it's an interesting story, but not worth the research, unfortunately.
No.